I want to talk to you guys about family banking today. And I mentioned it just briefly on the last video, but this is a guy who has this is his own, I don't know, his own company or whatever. Um, but anyway, this is his slide. I just want to talk a little bit about it. When you want to become very wealthy, when you want to become very rich, you have to go back in time and find out who was who was very wealthy and who was very rich, and what were some of the things that they were doing. And anyway, I'll let this video play out, and I've listened to it before, but it's been a long time ago. And I want to say that he's going to use two families. And the Vanderbilts were a very wealthy family, and 100 years later, there wasn't a millionaire among them. I think one of the guys on TV, he is one of the one of the news reporters. He is actually a Vanderbilt. He is one of the high profile. He is so he might have $1 million, but when they had a family reunion after 100 years, there wasn't a millionaire among them. They had squandered all that money. And this is why most people think that a lot of wealth and comes from old money and that kind of thing. But like I said, most millionaires in America are everyday people. They're teachers. They're engineers. They make $50,000 a year. They save 15%. They invest in the stock market. And after 40 years, they'll have $1 million or more, maybe 10 million. But anyway, I just want to play out some of this video, and some of it I might skip through. But
one of those is Cornelius Vanderbilt, who made his wealth in the railroad business. And the other man is Mayer Rothschild, who was a banker. Now, Vanderbilt died in 1877, and he had amassed a fortune of $105 million. That's Bill Gates kind of money in today's economy. In 1877, that was a huge fortune. He left $1 million to Central University, and they renamed that university to Vanderbilt University, which is probably why most of us remember the name Vanderbilt at all. And he left $104 million to his heirs. 92 years later, his heirs got together for a reunion at the college. 120 Vanderbilt descendants gathered, and interestingly enough, there wasn't a single millionaire among them. And so all of that money over those...
I want to let that sink in a minute. This guy had $104 million in 1877. Hang on one sec, guys. Give me a sec. don't even know how much things cost back then. But you know, everything was probably a penny. You could probably get, anything you wanted for 5 pennies. And this guy had $105 million back then. I mean, I don't even know what the U.S. economy or the GDP was back then. But just 100 years later, that $104 million was squandered by his family. So sad.
And he left $104 million to his heirs. 92 years later, his heirs got together for a reunion at the college. 120 Vanderbilt descendants gathered. And interestingly enough, there wasn't a single millionaire among them. And so all of that money over those 92 years had been dissipated. Now let's contrast that with the story of the Rothschilds. Mayer Rothschild died years before Vanderbilt did in 1812. And he had amassed a huge amount of money, but not near as much as Vanderbilt had. And instead of leaving all of his money to his heirs, he left them a system for building family wealth. He left them a banking system, if you will. And this is what that looked like. Number one, the family's wealth was to be kept together in one family bank. Step number two, the family could take a loan from the family bank anytime they wanted to, but they needed to pay the loan.
Now I'm not advocating that people actually, everybody doesn't need to do, like, all right, I'll give you an example. I had worked with somebody and their dad or whatever controlled all the money, and actually there's a couple people I've met that same thing. And you might have adult children that are still giving the dad every penny that they earn. And to me, that is more about control. And then if you're basically being a slave to your dad, and he could be cruel or maybe when he gets older, maybe he loses it mentally. And there was a story a couple weeks ago where a woman had drained their her and her husband's bank account and was throwing hundreds of thousands of dollars out the window on the freeway, and all that money was just gone. So there are risks involved in something like this. I definitely think that you can give a portion maybe to a family bank. I wouldn't give 100%, because let's say you do something that pisses your dad off or something, and he might say, all right, well, you're out of the family bank, and then you're basically homeless, and you've been paying in money your whole life to your dad, and I'm not saying I'm saying I'm sure there's a lot of people with very good intentions, and a lot of parents that are very nice but I'm just pointing out the risk and stuff like this, and basically the people I've known, that have gave everything to the dad, and even the it's just a sense of control, and basically, he would have, millions of dollars, and you would have, $100 to and you basically can't do anything. But anyway, this worked for the Rothschilds family. So this guy, he didn't have as much money as Vanderbilt, but he left them a system of the family bank. All right, let me continue.
Step number 2, the family could take a loan from the family bank anytime they wanted to, but they needed to pay the loan back. And then step number 3 was that once a year the family met together and shared their lessons learned, what worked, what didn't work, how money grew, how money didn't grow. And if they didn't do these 3 steps, they were out of the family bank. And currently the Rothschild fortune is estimated to be somewhere between $1 and $100 trillion. Nobody knows for sure.
I want to. I mean, people can't even fathom how much money that is. I mean, Apple was valued at what, 2 trillion, 2 or 3 trillion. Microsoft 2 trillion, somewhere around there. The whole U.S. economy is somewhere around 20 to 30 trillion a year. The whole world's GDP, the whole world's economy is like, I don't know, 85 trillion maybe. Like, here's this one family that has amassed over a couple hundred years, up, maybe $100 trillion. That's and the only thing I can compare to it was that there was an article a while back of the Mormon Church, and I can't remember how much money they had, but it was in the trillions. It was. I believe it might have been like 500 billion or something, but I want to say it was in the trillions. I'll have to go back and look at that, see if I can find that.
It's so much. The difference was he left a system for his family to operate within. And so it's not just time passing that causes money to dwindle away. It's whether or not you have a plan. And tonight we want to share with you a plan for building wealth. Now, the average American, he makes $1 million in his lifetime, but he doesn't keep it. For example, if a person earns $50,000 a year and he saves it all, and if he could grow that savings at just 5% a year, after 40 years he would have $6 million. So let's look at this little calculator. Annual income is $50,000. If you grow it at 5%, you're going to have $6 million at the end of 40 years. But one of the wealth stealers that we have to deal with in this world is taxes. So let's assume that a person's in the 28% tax bracket. Let's see what that does to our nest egg. Okay, well, we lost quite a bit of it. It leaves us $36 after taxes of that $50,000 that we earned. And now we have to spend money. We have to buy groceries. We have to pay for utilities. We need transportation. So let's say this person spends 90% of that after-tax money and see what happens to what he's got left. Wow, that makes quite a significant difference, doesn't it? And this person, we're going to say, is very conscientious. They save 10%. But you see, over 40 years, the loss of what could have been. And what do? We spend all of our time trying to cause that 10% that we might save, most people don't save that much, to grow at some rate so that we can get ahead. Well, obviously, that's not going to work. Most people think that to get ahead, they must work harder, they must stop spending, or they've got to take on more risk. Well, we can't work any harder than we do sometimes. Sometimes you get to the point where that's all one person can do. So that's not the answer. Stop spending? Well, we know that's not the answer because there are things that we must have. There's family needs that we must take care of to take care of our families. So we can't just stop spending. And so that leaves us, well, we must then take more risk. And we've been taught that this is the way to get ahead, but really I think that that's something that is not really true that we've been taught over the years. So is there a better way? Yes, there is. Let's look at 3 ways to view money. We can view money as a spender, we can view money as an investor, or we can view money like a banker does. The spender, he views money as a way to get stuff. Okay? We need to buy things, and every purchase that the spender makes is going to cost him interest. If you borrow and pay for your spending that way, you're going to pay interest. If you're like me and you save money until you accumulate enough to buy what you need and then spend it, well then what could have earned more money, more interest, more compounding, we have to give that up. Either way, we never build up any money. Let's take an example of buying cars as one way to illustrate this point. There's 3 ways that we can buy cars. We can borrow cash from a financier or a finance company or a bank or a credit union and pay for the car that way, giving up interest, paying interest for that. We can save up money and then pay cash for the car, or we can use the private family banking system to purchase our cars. Let's look at another graph here. Let's say the cost of the purchase of a car is $30,000. When we're younger, maybe the car will cost a lot less than that. As we grow older and a little more affluent, hopefully, we might pay more than that for a car. But let's just say over the average of our buying cars in our lifetime that the average is $30,000. If we're borrowing, let's say we pay 5.5% and we purchase a car every 5 years. After 11 purchases over 55 years, the borrower has spent $378,203. The cash buyer, he's been a little smarter maybe. He's only spent $330,000 because he hasn't paid any interest. But what about the bank? This is what we don't think about. What did the banker do? Well, he didn't make the car. He didn't sell the car. He didn't even buy the car. He just acted as the middleman for the guy that's saving his money and buying cash, and the guy who's borrowing that same money usually and paying interest for it. What does he make? Let's look down here. The banker makes $380,820. That's why people spend a lot of time and resources to build the bank, because you're going to make money no matter what. Whether you're a cash buyer or like I used to be or a borrower, you're going to come out ahead, $380,000 ahead. And so the banker is
that's should be mind blowing to people. I mean, I don't know. I didn't buy a car every 5 years, but I think the last vehicle I had was 20 some years. I had it for 20 some years, and at the end, my insurance was basically nothing. It was probably $30 a month, and the car's value probably was only worth $500 at the end. But unfortunately, I'm in this same position today where I had a couple of years ago bought a brand new car, and so ideally, I would like to be able to pay it off as soon as I can, because look at the amount of money over your lifetime that you have given the bank. You've given the bank almost $500,000.
You're a cash buyer, or like I used to be, or a borrower. A banker is who you want to be. Let's take a look at this another way. Let's talk about buying a $20,000 car. The borrower goes to the bank and he borrows $20,000, and then he pays off $5,000 and those 15 the first year. Then he pays off another $5,000 and those 10 the next year. He pays off another $5,000 and those 5, and then finally he pays the car off, and he's back to zero. What does he do then? Well, it's time to go buy another car. So he starts the process all over again. Borrowing, paying back, borrowing, getting to zero, and going down again. And at the end of his career of buying cars, what's he left with? He's left with zero money and an old car. Well, let's take a look at what happens to the cash buyer. Now, he's a little bit smarter, so he spends 1 year and he saves $5,000. The next year he saves another 5, he's got 10. The next year he saves another 5, he's got 15. And finally he's got the $20,000. So what does he do? He liquidates that $20,000, and now he's left with zero, but he's got a new car. And then what does he do? Well, he better start all over again. You see, the car payments really never go away, because if he doesn't start saving that $5,000 each year and accumulating that each year so that he can have $20,000 for the next $20,000 car, he's going to end up being a borrower. Either way, you're on a race to zero. What's he left at the end of his lifetime of buying cars? Zero money and an old car. So let's take a look at what the private family banker, what his system looks like. You see the red and the blue, that's the borrower and the cash buyer. The private family banker is building up, and over his lifetime of purchasing cars, he ends up with several $100,000 and an old car. Tonight we want to show you how you can do this for yourself. Let's take a look at the investor, though. Remember, we said you can look at it 3 ways: as a spender, as an investor, or as a banker. The investor views money as a way to buy investments. He trades his money for something that he hopes his investment goes up 10% the first year, and then the second year it goes down 10%. Are you ahead, or are you back where you started? Well, if it goes up by 10%, you have $110,000, and if it goes down by 10%, well, you've lost $11,000. You're down to $99,000. So you're not back where you started. What if you go the other way? What if it loses 10% the first year and gains 10% the next year? Are you back to even? Well, no. If you lost 10%, you've got 9.
Well, I don't necessarily agree with everything, but because even if the stock market stays flat and you are in a dividend paying stock, I mean, every year you're still getting dividends. Um, I think last year, I mean, I don't have very much money invested, but I don't have that much money, but I got $3,000 last year from dividends, and um, so to me that was a significant amount of money.
90, and if you gain 10% of that, you need to gain 11%.
But what a lot of people don't realize is when the stock falls 50%, you need it to go up 100%. If the stock falls 70%, you needed it to go up 233%, just to break even. So like he was saying, if you lose 10%, if it goes down 10%, you really need it to go up 11%. If it goes down 20%, you really need it to go up 25%. If it goes down 30%, you need it to go up 43%. If it goes down 40%, you need to go up 67%. That stock I was telling you about, BAK, I was down 40%. So it had to go up 67% for me to just break even. Um, and Einstein, one of the smartest people in the world, said, compound interest is one of the most powerful forces in the universe.
They know. I saw this question the first time, and I said, obviously no. It's better to liquidate and then make my purchase because I'm paying higher interest. But that's a false assumption. Let's look at this $20,000 car, for example, and we pay 48 months at 6%. Our payments are going.
And this was back in 2012 this video was made, but car payments used to be 4 years. Now they're 5, 7, however long. They're getting longer and longer.
Going to be $470 a month. The total outlay for that car over 4 years is $22,546. If at the same time that money was in our savings and growing for those 48 months at 4%, we would have, over that same period of time, $23,464. Well, let's change that to that $30,000 car that we're now purchasing. And we're going to finance it for 60 months for 5 years at 6%. Our payment's $580, so our total outlay is $34,799. $4,799 we're paying in interest. If that same money was earning at 4% over those same 60 months, our future value would be $36,630. So we actually are coming out ahead by borrowing the money and paying interest and keeping our money working at 4%. So what if you can take over your own banking function and say, let's make the loan interest rate 5%, and we earn at a rate of 5% also. Well, then you're going to see that difference is fairly significant. And that's what we can do as a private family banker. It makes sense to do it this way. So where do we put our money to do this? Well, there's 3 places where we've been taught to put our money. One of those places is we put our money in the stock market. But our future value would be 30.
So in this case, the guy's getting 4%, so it makes sense to get a 6% loan. Because the money he would be making would be more. I really don't want to get into insurance and all this stuff. But there's something later in the video that I really like is, all right, this is the average. Like I said, in America, the average savings rate used to be around 8%. Now, Dave Ramsey and other people will tell you, you need you should be saving 15 to 25% of your income for retirement. Probably closer to 25%. But the average American spends, and this savings rate today is like 2%. So it's no longer 10%. And like I said, it should be around 25%. I've been saving, when I've been working, 40%, or trying to, and I really could go up to 60 or 70% if I try a little harder, but yeah, the average person, they only save 2% right now, and 20% goes to auto loans, 30% goes to housing loans, and 40% goes to spending and just living, like food and gas and taking kids to the movies or whatever. But
about 30% goes to housing, and about 40% goes to living, and we try to save 10%. At least that's what we're told to do. The actual rate's probably closer to about 6% for the average American. Well, of that...
And like I said, this was back in 2012. Historically, the average is around 8%. But today, it's 2%, which is pitiful. But basically what the theory of this family banking thing is over the course of a person's lifespan, and average American will earn at least $1 million, but they won't have anything left over. They don't keep any of that money. They don't grow any of that money. As we have seen in the past, the average 65-year-old in America today only has $100,000 to retire on. That's pretty pitiful. I mean, if the average person makes $1 million in your lifetime and you only save 10%, you should have at least that much. But and that's not even including getting any return on your investment. That's just saving 10% of what you made. But this is saying, in auto loans, you let's say you paid 4% interest, and then when you're getting a housing loan, I mean you're paying the most of it in interest. Just like the video we just covered, a $500,000 house at 7.35% over 30 years, you will pay $1.2 million, and $700,000 of that is just interest payments.
money that we're spending.
And the theory is, if you can cut out paying the bank, uh, 34% or whatever is on interest, and we saw just the housing, I mean, just the car loans alone over a person's lifetime was somewhere around $380,000. Add another 700,000 for a housing loan. I mean, you've given the bank $1 million. You've paid the bank $1 million in interest. What if you could keep that money and grow that money at 4 or 5% or 10% or whatever, and then you're talking Rothschild money.
On autos, housing, and living, about 4.5% for autos is going to interest. About 25 of the 30% that we spend on housing is going to interest, and about 5% of what we spend on living is going to interest. That's 34.5% spend on interest. What if we could capture that interest that we've been paying to others? The interest portion. We make premium deposits or premium payments, depositing that money into our policy or money pool, and then we can use that and take loans and repay those loans to purchase cars. We can, instead of using credit cards, we can use loans and pay back as if we were paying back a credit card. And ultimately, we're going to be able to take over our own mortgages. My wife and I have been able to do that after just 5 years of putting our money into this system. And so what does that do? How would our savings change if we could recapture the money that we're throwing away on interest? It would look like this. Instead of just saving 10% and making that grow, look at the return we're getting if we could just recapture the interest that we're paying someone else, or that we're losing by paying cash. Here's another way to illustrate that. Over the years, that green shows what we're gaining and what's going to interest payments. If we put that interest payment on our side, it's like riding a tailwind instead of going into a headwind. The benefits of private family banking. It's life insurance, so it provides a death benefit for our heirs. We can use it for major medical expenses, like an HSA, without any of the penalties or any of the requirements that has. We can use our policy for disability protection by using a rider. We have guaranteed access to it, so it can become our emergency fund. We can use it as a college savings plan, as a 529 plan is set up, without the limitations or penalty.
But anyway, I found that interesting. But you make your own decision.